Have you ever wondered why Wall Street often seems to stay one step ahead of everyone else? By the time the average investor hears about a major market trend, institutional investors have usually been preparing for it for months. They study economic data, corporate earnings, interest rates, and global events to position their money before the headlines appear. Right now, another quiet shift seems to be taking place, and understanding it could help you become a smarter investor. After years of high inflation, rising interest rates, and economic uncertainty, many professional investors are changing their strategy. Instead of chasing every fast-growing stock, Wall Street is becoming more selective. The focus is shifting toward companies with strong earnings, healthy cash flow, and solid balance sheets. In today's market, profitability matters more than promises. Investors want businesses that can continue growing even if the economy slows down. Artificial intelligence remains one of the biggest investment themes, but Wall Street is looking beyond the biggest tech names. Institutional investors are increasingly putting money into the companies that power the AI revolution. Semiconductor manufacturers, cloud computing providers, cybersecurity firms, networking companies, and businesses building data centers are becoming key areas of interest. The reason is simple. Every AI application depends on powerful chips, secure networks, reliable cloud infrastructure, and massive amounts of electricity. Instead of betting on a single winner, Wall Street is investing across the entire AI ecosystem. At the same time, investors are quietly rotating into sectors that have historically performed well during uncertain times. Healthcare continues to benefit from steady demand, utilities are gaining attention because of rising electricity needs, and infrastructure companies are expected to benefit from long-term government investment across the United States. These industries may not grab headlines every day, but they often provide stability when markets become more volatile. Another noticeable trend is the return of dividend-paying companies. With interest rates still relatively high, businesses that generate consistent profits and reward shareholders through dividends are becoming more attractive. Companies with strong financial positions and reliable cash flow are once again earning the attention of institutional investors. This doesn't mean growth investing is over, but it does show that quality and financial strength are becoming increasingly important. Risk management is also playing a much bigger role. Instead of concentrating all their money in one sector, professional investors are diversifying across industries and focusing on long-term opportunities. They understand that protecting capital during uncertain periods is just as important as achieving high returns during bull markets. This disciplined approach has helped many successful investors navigate changing market conditions over the years. So what does this mean for everyday investors? It doesn't mean you should copy every move Wall Street makes. Instead, pay attention to the broader trends. Focus on financially strong companies, diversify your portfolio, invest consistently, and avoid making emotional decisions based on short-term market swings. The biggest gains in investing often come from patience and discipline rather than trying to predict every market move. Wall Street may be quietly repositioning for the next phase of the market, but the opportunity isn't limited to institutional investors. By understanding where professional money is flowing and staying focused on long-term investing principles, you can make more informed financial decisions. Remember, every investment carries risk, so always do your own research and invest according to your financial goals. If you found this video helpful, don't forget to like, subscribe, and share it with someone who wants to stay ahead of the market. Thanks for watching, and I'll see you in the next video.